Right now, the silver market is flashing one of the most important warning signals we've seen in months. Prices are hovering near $81, and on the surface, it looks like strength. Many retail investors see this level and assume the rally is unstoppable. But beneath the surface, something far more complicated is unfolding. The COMEX futures market is sending mixed signals, institutional positioning is shifting rapidly, and geopolitical tensions are adding fuel to a market that could move violently in either direction. If you're holding silver, trading it, or thinking about entering the market, what happens in the next few weeks could determine whether silver surges to new highs or drops quickly toward the $68 level. Let's start with the current situation. Silver recently pushed toward the $81 mark after a wave of safe haven demand triggered by global uncertainty. Central banks around the world continue to accumulate gold aggressively, and historically, when gold moves, silver eventually follows with amplified volatility. But here is the critical detail many investors are missing. The paper silver market on COMEX is showing signs of extreme leverage. Open interest has expanded sharply while physical inventories have not increased at the same pace. That imbalance is often the precursor to dramatic price swings. Insider traders and institutional funds are already adjusting their strategies. Several large hedge funds have started reducing long exposure in silver futures while increasing options activity. That type of positioning suggests they're preparing for a potential correction. Not necessarily a crash, but a fast, sharp move lower that could shake out weak hands before the next major rally begins. And that brings us to the key number being discussed quietly among professional traders right now, $68. According to several technical models used by institutional desks, the $68 zone represents a major liquidity pocket. It's the area where large buy orders are waiting if silver experiences a correction. In other words, if prices drop quickly, that's where the market may attempt to stabilize before the next move higher. But why would silver fall if the long-term fundamentals remain bullish? The answer lies in short-term market mechanics. Futures markets are dominated by leveraged positions. When too many traders pile into the same bullish trade, the market often corrects simply to rebalance positioning. A sudden pullback can trigger margin calls, liquidations, and algorithmic selling, pushing prices down much faster than fundamentals alone would justify. Another critical factor is the US dollar. Whenever the dollar strengthens unexpectedly, commodities priced in dollars often experience temporary pressure. Recent movements in global bond markets suggest we could see volatility in currency markets again. If the dollar spikes even briefly, silver could react with a rapid downward move. Now add geopolitics to the equation. Tensions across multiple regions continue to escalate, and historically precious metals react strongly to geopolitical risk. However, the reaction isn't always straightforward. Sometimes metals surge immediately, but other times, markets initially move lower as liquidity tightens, and investors temporarily shift into cash or U.S. treasuries. That dynamic can create sudden drops in silver before safe haven buying returns. This is why experienced precious metal investors focus not only on the headline price, but on market structure. When silver trades near major resistance levels like the current $81 zone, volatility tends to explode. Breakouts can happen quickly, but so can aggressive reversals. The market essentially compresses energy, and eventually that energy releases in a powerful move. Let's talk about the bullish case for a moment, because it's still very real. Industrial demand for silver continues to grow due to solar technology, electronics manufacturing, and emerging energy infrastructure. Silver isn't just a precious metal, it's a critical industrial resource. Supply growth has struggled to keep pace with demand, and mining production remains constrained in several regions. Over the long term, those fundamentals support significantly higher prices. But markets never move in straight lines. Even the strongest bull markets include violent corrections designed to shake out impatient investors. If silver drops from $81 toward the $68 region, it doesn't necessarily mean the bull market is over. In fact, many seasoned traders would view that type of pullback as a healthy reset before the next rally phase. The real question investors must ask themselves right now is simple. Are you prepared for volatility? Because the silver market is entering a period where moves of $5 to $10 in a short time frame are absolutely possible. For long-term stackers accumulating physical silver, price drops may represent opportunity. But for leveraged traders in futures markets, those same moves can become extremely dangerous. One of the biggest warning signs appearing right now is the divergence between retail enthusiasm and institutional caution. Retail investors are increasingly bullish, driven by social media excitement and the fear of missing out on a major rally. Meanwhile, professional traders are quietly hedging their positions. Whenever those two groups move in opposite directions, markets often experience sudden corrections. Another signal worth watching is COMEX warehouse inventory levels. If physical silver begins leaving the exchange at an accelerated pace, it could trigger supply fears that push prices much higher. But if inventories remain stable while speculative positions grow, That imbalance could contribute to the kind of correction many analysts are warning about. So, what should investors be watching over the next few weeks? First, keep an eye on the $81 level itself. A strong breakout above that price with heavy volume could invalidate the correction scenario and send silver rapidly toward new highs. But if the market repeatedly fails to hold above 81, that could signal exhaustion among buyers. Second, monitor the behavior of large institutional traders. Changes in options positioning, future spreads, and open interest often reveal what professional money is doing long before the price move becomes obvious to retail traders. And third, pay attention to macroeconomic headlines. Interest rate expectations, currency volatility, and geopolitical developments all have the potential to trigger sudden moves in precious metals. The bottom line is this: silver is entering a critical moment. The market could surge higher from here, but it could also experience a sharp pullback towards $68 before the next rally begins. Either way, the next phase will likely be fast, volatile, and extremely important for anyone involved in the precious metals space. This is exactly why staying informed matters more than ever. Markets move quickly, and the investors who succeed are the ones who recognize warning signs before the crowd reacts. If you want real-time insights into silver, gold, and the evolving dynamics of the COMEX market, make sure you subscribe now and hit the bell icon so you never miss critical market updates. The precious metals landscape is changing rapidly, and the information you receive today could determine the decisions you make tomorrow. Stay informed, stay ahead, and remember that in markets like silver, preparation is everything. Because when the next major move begins, whether it's a surge past 81 or a rapid drop towards 68, it will happen faster than most investors expect.